Hello and welcome to Pro Trader Strategies market commentary for Thursday, December the 1st. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters, I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. We've got a lot of PMI data coming out across the pond and here in the United States. PMI, remember, is the Purchasing Managers Index. So that is one of the more important economic data points that we get, especially on the manufacturing side, because it's the purchasing managers really kind of determining whether or not demand is starting to ramp up. And if they see demand ramping up, then they're going to start purchasing more of the raw goods to go into that manufacturing process. So we had Spanish PMI come in at 54.5, slightly above the expected 53.7. And one other caveat to remember with this PMI number: anything above 50 is expansion in the economy. Anything below 50 is a retraction in the economy. So having said that, we also got the Swiss manufacturing PMI come in 56.6, a lot higher than the expected 54.4, and we had the French PMI come in right in line with expectations at 51.7. The German manufacturing PMI came in at 53.3, again slightly below expectations, but pretty much in line for all intents and purposes. And then we also got the overall European PMI come in lockstep with the expected 53.7. We also got the Great Britain manufacturing PMI came in a little bit lower than expected at 53.4. It was expected 54.4. So for all intents and purposes across the pond, those data points came in better than expected on the PMI front. Then they also had the European unemployment rate come in at 9.8, better than the expected 10%. Then here in the United States, we got challenger job cuts at negative 13%, which is a little bit better than what we've seen in the past. We've seen a lot more, but remember, we're going into a holiday season, so a lot of these unemployment numbers aren't going to really reflect the state of the overall economy. We got unemployment claims come in higher than expected at 268,000 versus the expected 252,000. Again, people out there looking for at least part-time work coming into this holiday season. Then we also got the RBC manufacturing PMI in Canada came in line with expectations at 54.1. Here in the United States, we got the final manufacturing PMI came in at 54.1, in line with expectations. And the ISM, which is the Institute for Supply Management, that is our big PMI number. It is the one that is the most widely looked at. Came in at 53.2, expected to be 52.1, so better than expected on that front. And then the ISM manufacturing prices paid came in slightly higher than expected at 54.5, expected to be 52 even. Then construction spending came in line with expectation at 0.5%. And finally, to round it all off, we've got the natural gas storage came in at 50 billion cubic feet drawdown, right in line with expectations. And throughout the day, we have vehicle sales coming out from just about everybody. So you have to keep your eye out for that one and just watch those data points come out as they come. On to the overall markets, we've got crude oil /CL again screaming higher, well above that $50 a barrel area and above that 61.8 Fibonacci level that just kind of blew through there. We settled above that yesterday, so it is a green light to the upside in oil. It looks like it's going to be testing that $52 a barrel area probably. I'm not really expecting it to happen today, but it could easily happen tomorrow or into next week. You know, the reason why oil is screaming higher is because OPEC had that meeting. I was saying that I didn't think that they were going to come to any consensus on that, but Saudi Arabia took a bigger cut back on their production in order to allow a couple of other people to increase their production, and that kind of got them all to the table, and altogether it was more of a freeze on production. Now, is that good? Is that bad? Well, it's actually good for the United States because it allows these guys in the Balkan oil fields, Texas, the oil riggers, to really start ramping up production here in the United States. So it is somewhat good for our economy on that front, but higher oil prices isn't always a great thing when it's just production cuts to increase oil prices, because that really kind of puts a crimp in the spending of the consumer, because if you have to spend on gas, you can't spend on other ancillary type of products. So crude oil cruising higher right now, up over $2 on the day. Gold looks like, gold's been fighting itself back the past few days. We are in a downtrend, confirmed downtrend. It's down almost $4 today, down about $3.80, but coming back from the lows of the day and starting to look like another hangman doji right there, which is where a real battle of the bulls and the bears are taking place. So we are in a confirmed downtrend with the crossing of the 200 and the 50-day moving average, and we're well below the 9-day moving average, which is another indication of a short term. The 9-day is a short term bearish trend, and that cross is a major trend developing. So keep that in mind for if you are a gold bug, that prices could continue to slip lower. Then on to the bonds, down another 2 points today. Yesterday during the market commentary, I was talking about bonds being down 2 points. Today, again, down 2 points. Glad I pulled the ripcord on my TLT iron butterfly yesterday, because that would have started really looking kind of nasty today. Now, on to the overall equities. We got, again, another mixed bag where we're seeing a lot of money being pulled out of the tech sector, put into the Dow Jones and like the Russell, so the small caps in the Russell. But Dow Jones not making a historic high, which I thought we were going to continue to say almost every day on the market commentaries, but up quite nicely today, up over 82 points as we speak. Then the NASDAQ, this is what I'm talking about, the mixed bag. We're seeing that sector rotation out of tech and into the Dow and things like the Russell. Even the E-mini S&Ps were trying to push a little bit higher today at one point. But we got the NASDAQ down quite big, over a percentage point, and down almost 59 points as we speak here. And to note, it is below that point of control, the value area where the most time and volume has been spent. E-mini S&Ps just in slight negative territory, down 1.5 points on the day. We could call that pretty much unchanged for the most part. That could change in a matter of seconds, but really starting to consolidate. It is above that 9-day moving average, and which shows that it is still in an uptrend as we go. This is the breakdown of the E-mini S&Ps on a 15-minute chart. You can see on the data points when we started getting good economic data here in the United States out of the PMI. Even yesterday when I was talking about the daily market commentary, I was saying, the euphoria of these good data points is going to set in, and that's going to make the market realize that the Fed is got a green light to start raising rates. Then and that was going to cause the market to kind of come off, and that's what happened yesterday. We actually went below the overnight lows to close there, and then today again chopping around on the data points. We were right before the data points, we were rallying as those numbers started coming out here in the United States. The overall markets really started to slide. I think it's really due in part to the fact that it is looking like the Fed could be raising rates rather soon. Now onto the USO trade. Now if you guys remember, I put this trade on ahead of that OPEC meeting, sold some calls in there, and I sold the January 11 calls. And the reason why I did it, I thought they weren't going to have anything come out of that meeting. But as you can see, I was directionally wrong on that. Plus I was trying to play the high implied volatility for that. Got the high implied volatility, so it's hurting a little bit. But at the end of the day, I needed to start looking to be mechanical with this if oil continues to push a little bit higher. So I went into the January again and sold the 11 puts for 42 cents. So now I've created a straddle in there. So I'm looking for it to kind of hang out here for a little bit, get some little bit of theta decay, and try and cover that strategy for at least a scratch. Hopefully, if we can stay right there, pin at 11, I will be very, very happy. But I've increased my break even on this trade to just around 12-ish in USO. So my break even's 12 to the upside and probably closer to 10.50 on the downside. So be mechanical with that one, trying to stay in line with that. So anyway, tomorrow's webinar is going to be on the call diagonals. It's a really good one, especially as we float out of earnings season, I should say. And this is a good time to put on after any earnings season for that matter, because we start seeing a lot of volatility contraction going on. A lot of these stocks have low volatility after those earnings, and we're going to try and take advantage of expansion in volatility going into the next earnings season. So we're going to try and pay for some of those calls here in the near term, and then finance that for the next earnings cycle. So stay tuned for that. Go to protraderstrategies.com, sign up for that. Should be a really good one. I hope we get you all there. We've increased the room size so that we can fit more people in there, because we've been going over subscribed to that. So we're trying to take advantage of that, or trying to help you guys out so everybody can make it for that. All right. If you can't take that, take it easy.